Thursday, August 4th, 2022, Monaco 64, home of alternative economics and contrarian views. Today we're going to look at how the world's biggest hedge fund sees a stagflationary environment for years to come. Before I start, I like to say that a lot of you, of course, have asked me for years where they can get gold and silver, and I've provided a couple of affiliates. One of them is Gold Investments. They're arguably one of the oldest bullion dealers in the city of London. My promo code with them is Monaco64. They'll give you a small 0.5% discount on your price of physical gold and silver. They've been family run for 40 years. I started dealing with them back in 2002 with Mike Tempo, and now his sons Oliver and Simon run the operation. The other one is Glint. Glint is a little different. They hold your gold, physical gold, in Switzerland, in the Brinks Vault, at Zurich Airport, in an allocated account, and they give you the wherewithal to spend that gold through a MasterCard, and they also have the Glint app, of course. That's the way to open your account with them. My referral code there is MarioGlint79, and the details for both affiliates are below in the description. So I would say investment and putting your money to work is always about studying fundamentals, studying the business, studying the economic environment, monetary environment, and using those inputs to make a judgment and a decision that isn't certain, of course. There's probabilities that things will happen, and that's how I think people need to position themselves. They need to do their homework. I'm not here, and nor is the world's biggest hedge fund, trying to tell you what to do, but trying to give you their thoughts, what could happen. And that's what I wanted to say before we go into this publication that came out yesterday. I think they do a monthly publication from their Chief Investment Officer, or CIO. And it's Bridgewater Associates, of course. So they were founded in 1975, and they run about 150 billion. So they have 150 billion dollars in capital under management. So it's a big hedge fund, and they've returned about 52 billion in gains to investors. So they know what they're doing, even though there were rumors back in 2019 during the repo crisis that they were in trouble as well. So we need to keep all of that in mind. But I think it's important to point this out to you, that they think the market is price perfection, and we're going to look at that. So let's go through what Bob Prince, who's their CIO, said. And I'm going to put a link to this in the description because I'm not an investor at Bridgewater. I think you need millions there to open an account, but they're kind enough to make this public. So basically, they say that the odds favor a stagflationary environment that could last for years. And I tend to agree with them. I think that's one of the possible scenarios. I've spoken here how we're in the 1970s style stagflationary environment. I also think that one of the probabilities could be a hyperinflationary collapse. I haven't changed that. I think both are very likely. They don't speak about that, but just wanted to put that out there. And I'm going to be very brief. I'm going to make a very brief summary of what they've said, and then you can read the whole thing. So basically, they think, like I do, that central banks were too late in tightening after what they call MP3. I haven't found the definition of that, but I assume is monetary policy 3. I guess that was the huge stimulus that we saw back in 2020, 2021. Yeah, so they said they were too late in tightening. And so they've lost control. They're behind the curve. But at the same time, they say that due to the dual mandates of central banks of price stability and full employment, they can't go too far either way. What does that mean? Well, they can't tighten too far and they can't also loosen too far. Because they've got these dual mandates, they will have to loosen, as they say, eventually, or else full employment goes down the drain. And according to them, this will toggle back and forth with tight and loose monetary policy for years. So they won't be able to do what the market's thinking. We're going to come to that in a minute. So this toggling back and forth between tight and loose policy, they think it will result in too high inflation and too low growth or full employment. And that's the definition of stagflation, of course. So this is what he thinks the markets are discounting right now. And I think what they mean is the markets are priced for perfection, or even what we call goldilocks, a perfect environment for investing and the economy. So I quote, "The markets are discounting a very different scenario. They're discounting one sharp round of tightening comprised of a rise in short-term interest rates to just above 3%, combined with more than 400 billion of contraction of the Fed's balance sheet, and that this will be enough to bring inflation down to 2.5% with stable growth and no dent in earnings. From there, markets are discounting that the achievement of these goals would allow a subsequent 1% drop in rates from their peak." So yeah, the markets are discounting this, and they think that the markets are wrong, and I do too. Of course, as John Maynard Keynes once said, markets can remain irrational longer than you can remain solvent, and that's why leveraging yourself is very dangerous in this environment. By the way, that's one of the only things I think that, in my opinion, John Maynard Keynes said of any great value, because his economic theory, I think, was not even economic. It was more like, I don't know, voodoo economics. Now, I want to look at what they think are going to be the worst performing countries in this environment. So here you go. They've got the US. They see the US in the next year with minus 2.6% growth and 5.7% inflation. The UK comes in second. That's not a good silver medal there. That's a bad one, as you can see. Canada, Europe, and Australia picking up the rear. And they see China doing well, low inflation and relatively strong growth. So now we're going to look at how Bridgewater sees global asset performances in different environments. So it says here, this mismatch between what is discounted and what is likely presents substantial ongoing risk to assets. The following table shows the historical returns of assets in stagflations and is compared to returns the rest of the time. Equities have been the worst performing assets in stagflation. So you can see here stagflation, frequency of environment, and that's from 1960 to 2022. So that 18% of that time we've had stagflation, and you can see inflation-linked bonds 1.02%, gold 0.67. That's the Sharpe ratio. Broad commodities 0.58, and just look at the excess returns. They're all in gold and commodities, and also inflation linked bonds, and that's why I've been favoring commodities for the last 2.5 years, and precious metals actually for the last since 2002. I think precious metals outside of stagflation has also been a good place to be since 2002, and I think it's going to do even better in this current stagflationary environment that Bridgewater and I see as well. And I would add gold to gold, and broad commodities, silver, of course. So, and that's where we stand in terms of my views. Kind of correspond pretty much with Bridgewater and its CIO Bob Prince. I think though there is a possibility of something more than just stagflation or a hyper stagflation, and that would be an interesting environment. I think it wouldn't change things that much in terms of performance here, and they've got a table here, global asset performance during stagflation, so they're not comparing it here. So you've got here excess returns, and you can see that gold and broad commodities lead the way. Inflation linked bonds not so good, but yeah, with that, let's quickly look at where the markets are this morning. Just like to say that today at midday London time, the Bank of England is expected to raise rates. I think they'll raise by 50 basis points. I think they're way behind the curve, as Bridgewater thinks. And yes, they're going to tighten for the next few months. And then they'll probably loosen again, and it's going to be a toggling back and forth, like they say. And I think we have a danger of more than just stagflation here in the UK, because we can't really afford to tighten too much, or else it will bring the whole economy down. Our economy is highly leveraged through the housing market, through corporate debt, through consumption, borrowing and spending. It's not a healthy economy. We've gone away from manufacturing to a mainly service and financialized economy. So yeah, 8:36 a.m. London time. We've got spot gold at 1773.50. It's up $8 or 0.5%. Silver's up 4 cents. So underperforming a little bit. It's at 20.08. High's been 17, low 1995. The high in gold is right around here, 1775. The low 1763. So yeah, that's why I think the markets are still undervaluing gold and silver and commodities in the last few months, especially because they think everything's going to be fine, that the central banks will be able to extricate themselves from this pickle. And my bet is that they won't, just like Bridgewater. So the Dow futures is up 28, NASDAQ futures is down 8, and the S&P is unchanged. So relatively quiet markets this morning. The FTSE is up 11, Eurostoxx 50 is up 24. To the currencies, sterling is up 0.25%, 121.75. The euro is up 0.2 at 101.85. The dollar is up 0.1 at 134 versus the yen, and the dollar is unchanged versus the Swiss franc, 96.12. Unchanged versus the yuan as well at 6.76. And the dollar's up slightly versus the ruble, is trading just above 60. So pretty much where we were yesterday. To the rest of the currencies here, Aussie dollar is up 1/3%, 69.71. Dollar is unchanged versus the Canadian, 128.42. And the Kiwi dollar is up 0.5%, 63.03. To the general commodities, WTI crude is unchanged at 90. So we've come off a little bit in the last few days in crude oil. Brent crude is down slightly at 96.13. High-grade copper down 1% at 3.44. U.S. nat gas unchanged at 8.26. The Dutch natural gas futures is back below 200. It's trading around 198. To finish off, we're going to look at the 10-year yield and the treasury market or bond market. So we've got the 10-year down 3 basis points at 272. And the 2-year is down about 2 basis points at 309. So there you go. The curve is still inverted quite significantly. And that's pointing to a slowdown. And yes, that toggling back and forth, right? So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And with that, I wish you all a great day. Take care. Bye.